If you are a Canadian investor who owns US assets, there's probably a pretty good chance you're aware of this much hated 15% withholding tax that is applied to dividends that are paid by these entities. In other words, if a company pays a $100 dividend, you're only going to get $85 of that. The US government is going to withhold 15% of that before the money even comes to you. In this video, I'm going to take this very convoluted, very confusing situation where we have all different types of ETFs, different types of accounts, try and simplify it and put it into terms that you can understand. At the end of the day here, I want you to be a better, more informed investor. And if you are a Canadian investor, you should, I would almost say you have to own at least some US investments, some global investments. When we think about the Canadian market, it's actually very small in the big scheme of things. Around 3% of the world global equity markets are made up here in Canada. And the markets here are relatively non-diversified. They're very heavily weighted in, for example, the energy sector, the financial sector. But there's a lot of other sectors out there that you do want to get exposure to that you just can't really do that in Canada here. An analogy that I draw, it's almost like when you go to a buffet and you're looking forward to dinner and you limit yourself to just the salad area. You've got your seafood, you've got your meats, you've got your dessert section. All of these would be off limits to you if you focus just on the salad. And that's kind of what it's like if you invest only here in Canada. You're limiting yourself to the small selection of choices that we have here in our country, and you're basically depriving yourself of all the other opportunities that are available on a global basis. Now, a quick primer here. Certain types of income that you get from foreign investments, whether that's US or abroad, are subject to withholding taxes. And there's a lot of confusion over the type of taxes or when you in fact are subject to this tax. There are two key factors, if you want to understand this, that you have to understand. Really only two things. There is the structure of the ETF. We're going to talk more about that in just a moment here. There's also the account type that you're holding it in. Let's start by looking at two overall structures. At the highest level, there's two things we're going to look at. We're going to look at Canadian listed ETFs. So these are ETFs that you would buy on the Canadian markets, typically the Toronto Stock Exchange, hold a variety of assets, or you have US listed ETFs, and they would trade on ARCA or a division of the New York Stock Exchange. Now, at the next level, there are three types of Canadian ETFs. You can own an ETF that's listed here in Canada, which holds US or international stocks directly. Now, you can also own a Canadian ETF that invests in a US ETF, which then owns US stocks. Or you can buy a Canadian ETF, which invests in a US ETF, which then goes ahead and owns international stocks. From the US side, two types we're going to look at here today. You're going to look at a US listed ETF that owns US stocks directly, or a US listed ETF that owns international stocks. As far as account types go, let's look at the three account types. There's a tax-free savings account, which we're all familiar with here. Most of us are. Now, in this video, when I say TFSA, there's a couple of other accounts that are the same tax rules. There's the RESP and there's our RDSP, the Registered Disability Savings Plan. So when I'm doing the video today, if I say TFSA, it's including the TFSA, the RESP, and the RDSP. Now, the second group of accounts, I'm going to use RRSP, but this could be an RRSP. It could be a Registered Retirement Income Fund. It could be a locked-in RRSP, a locked-in RIF. Basically, that category of funds that encompasses that registered, the retirement element of our overall tax system here. Thirdly, I want to look at taxable accounts. So other names you might hear, you might have a margin account. It's taxable. You might have some people just call it an investment account. Some people call it a cash account. That is another type of account that is not one of the registered accounts of some nature, not a TFSA, it's not an RESP, it's not an RRSP, etc. Straight old taxable account. Now, the last sort of structural thing we need to understand, there are two levels of withholding taxes that may be applicable to your investments. Number one, I'm just going to say it's the first level or level one. These are withholding taxes that are imposed by the country in which the company that you're invested in is domiciled. So if the company is an American company, the US government will impose that withholding tax. If it's a company from the EU will impose that withholding tax before, they'll withhold that at source before you get your distribution. That's sort of level one. Now, there's also a level two tax, and this is a tax that is withheld by the US when they pay a distribution to a Canadian ETF, for example. And we're going to get into all the details of this as we go through here. Last point is tax recovery. And Canada has tax treaties with a number of countries around the world, including the US. And there are cases where even if that withholding tax is withheld at that source, in some account types, which we'll look at here in just a moment, you can actually recover that. You can claim that foreign tax credit when you file your tax return. So that's kind of the baseline here. Now let's go into specifics. I'm going to start with the overall scenario of RRSPs. Let's look at two of these ETF structures and drill down. First one we're going to look at is a Canadian listed ETF, which holds US or international stocks directly. And we're also going to look at a Canadian listed ETF, which holds a US listed ETF, which holds US stocks. Now, in this case, even if it's in an RRSP, the fund will be subject to level 1 tax. And this is not recoverable because it's in an RRSP. You can't claim that on your tax return. So if you have one of these types of funds, there will be withholding tax of typically 15% on that fund. The next group I'm going to look at here is a Canadian listed ETF, which holds a US listed ETF, which then holds international stocks. Now, this is one of the worst cases you can have because you now are going to have two levels of withholding tax. You're going to have that first level one I talked about, where let's assume you have a British company. It's going to withhold 15% tax before it gives the distribution to the US ETF, which is then going to have another 15% withheld before they flow that through into Canada here. And of course, you cannot claim the foreign tax credit on that. Next structure, a US listed ETF, which holds US stocks. This is probably the best type, purely from a tax perspective, purely from a withholding tax perspective, that you can have. There is no foreign withholding tax on this structure. Now, there are a lot of other considerations, which I'm going to cover off a little bit later in the video here. So it's not always about the withholding tax, but that's something that you should be aware of. The last structure here under RRSPs is a US listed ETF that holds international stocks. Now, in this case, level 1 will apply. Not recoverable. I'm now going to move to TFSAs, which covers RDSPs. It also covers off the RESP. So 3 of the top level structures. Let's review here. Canadian listed ETF that invests in a US or international equity directly. A Canadian listed ETF that holds a US listed ETF, which invests in US equities, and a US listed ETF that invests in the US equities. In a case like this, inside of your TFSA, one level will apply. That 15% withholding tax will be applicable in that case here. 2 different structures here under this TFSA banner. We have the Canadian listed ETF, which holds a US listed ETF, which holds international stocks, or a US listed ETF, which holds international stocks. Now, in this case here, this is probably the worst case scenario. You're going to have both taxes apply. First of all, you're going to have that level 1 tax that applies into the US ETF, and then you're going to have this level 2 that applies as well. Now, for a taxable account, so this is an account, margin account, investment account, cash account, etc. 2 main groups I'm going to look at here. Top level ETF structures. We've got the Canadian listed ETF that invests in US or international stocks directly. We have a Canadian listed ETF that invests in US ETF, which then invests in US equities. And we have a US listed ETF that invests directly in US equities. In all of these cases here, that level 1 tax will apply. Now, the good news here, because it's a taxable account, you probably can recover that when you file your tax returns. You will claim that foreign tax credit, most likely be compensated on your taxes for that. Second group of funds we're looking at here, Canadian listed ETF, which holds a US listed ETF, which then holds international stocks, or a US listed ETF, which holds international stocks. Now, in this case, both level 1 and 2 taxes will apply. 15% from the source company when it originates, and then 15% again coming from the US up here into Canada. The good news here is that that second level, you can claim as a foreign tax credit on your tax return, but not level 1. As I mentioned earlier, there are other things to consider. You can't just let tax be the only consideration, especially something like a withholding tax. What else do you think you need to know in order to make the proper investment decisions? Well, let's go through a few of those things here. Number one of the benefits of owning a US ETF, usually the management fees on an American ETF are going to be lower than their counterparts here in Canada. Now, not a huge amount these days, but purely from a cost perspective of owning that fund, yeah, you can probably get a better price on that by owning the US asset directly. Now, of course, if you are buying a US asset, well, you've got Canadian dollars here. So you take those, you convert them into US, then you buy the asset. So there's going to be a foreign currency adjustment and exchange that is an additional cost that you would have to be aware of there. Also, if you own U.S. assets and a U.S. ETF, a U.S. listed ETF, falls into that category, there are a lot of other tax reporting and compliance issues that may come into effect. Certainly, if you have $100,000 or more of U.S. assets, there's a Form T1135 that needs to be completed when you file your tax returns every year. Also, Canadian citizens who own more than $60,000 of what's called U.S. situs assets, so a U.S. listed ETF would fall into this category, may be subject to U.S. estate tax issues, or at least a tax filing obligation because you do own that asset. Now, generally speaking, only the wealthiest are going to have that issue. At the lower amounts, there's a lot of exemptions there. Anytime you might fall into that situation, of course, consult with the appropriate tax professional, but it is something that you have to be aware of, or that you should be aware of if you're going to be investing in U.S. assets. Lastly, on this, whether you should own U.S. or Canadian directly, the adjusted cost-based calculations, if you own a U.S. asset in this respect, are more onerous because when you do you make different purchases or sales, the foreign exchange on the day that those sales are made have to be factored into this as well. Now, understanding how these taxes work is obviously really, I would say, a critical part to your overall investing picture. Like I said, don't let just the taxes or the foreign withholding tax drive that bus. You always have to consider the big picture. Now, we do have an awesome video that shows taxes in more detail right here in Canada, and I'll link that in the video right here. Thank you so much for watching. I look forward to seeing you in the next video.